Let me clear something up real fast. A cap rate is not necessarily a return. It's not exactly a yield, and it's definitely not the thing that makes a deal good or bad. It can be, but not always. If you misunderstand it, you will likely overpay for a property or miss out on a great one. So let's break down what a cap rate actually is, how investors use it, and why it matters. At its core, a cap rate or capitalization rate is simply net operating income divided by purchase price. That's it. If a building produces $500,000 in net operating income and it trades for $10 million, the cap rate is then 5%. This number tells you what the market is willing to pay for a stream of income today, assuming the property is bought with all cash. No debt, no leverage, no personal return assumptions, just the property's income divided by the purchase price. Higher cap rate doesn't automatically mean better deal, and the lower cap rate doesn't mean it's overpriced. Cap rates are about risk and certainty, not upside. A low cap rate usually means stable tenants, long leases, strong locations, and a predictable income. A higher cap rate usually means more risk, shorter leases, operational issues, or future uncertainty. The market demands a higher return because there's more that can go wrong with it. Think about how a multifamily property can usually trade for 5% cap rate, while hotels can go for more like 10%. That's because multifamily is seen as a safer bet as opposed to the operational risk of hotels that can fluctuate with the market. So the cap rate isn't judging the deal, it's describing how the market feels about the income. Professional investors use cap rates in three main ways. First, pricing and valuation. If you know the stabilized NOI and you know the market cap rate, you can estimate the value. NOI divided by the market cap rate equals value. That's how to quickly price a property. Institutional assets are especially priced this way. Second, comparing similar assets. Cap rates only make sense in context. You compare similar property types in the same market with similar risk profiles. Comparing a suburban strip center to a Class A downtown office building doesn't tell you much. Cap rates are a relative metric, not a universal one. Third, measuring market sentiment. When the cap rates compress or lowers from, let's say, 6 to 4%, it means more buyers, more confidence, and more capital chasing deals. When cap rates expand or increases from, let's say, 7 to 8%, it means higher interest rates, more uncertainty, or tighter capital markets. Cap rates tell you what the market believes, often before the headlines do. So here's the takeaway. A cap rate is a pricing tool, a risk indicator, and a snapshot of a market sentiment. It is not your return. It does not include debt financing, and it does not tell the full story of a deal. Great investors understand what's behind the cap rate. If this is helpful, like and subscribe. If you've got a question, leave it in the comments below. Thanks for watching.